Hey everyone, Drew Creekmer here, Wealth Advisor with Creekmer Wealth. Hope you all are doing well since the last time we chatted. In today's flash briefing, we're going to further dive into the impact that emotions have on us as investors and why it's critical for you to know yourself and know how you've reacted emotionally to market swings in the past and make sure that you have a process in place to help you manage those emotions. I have this fun chart up here on the screen talking about the cycle of market emojis or market emotions, and kind of walking through how we have so often reacted ourselves or we've seen our clients react in the past. And, so usually whenever market trends or bull markets start, we have great optimism about the future. And as we see our investments grow and the market rise, we start feeling excitement, we feel the thrill of making money. And then we start peaking around having some euphoria. And typically euphoria leads into a feeling of complacency where we think, man, it's just everything's going great. What could go wrong? I'm just going to keep printing money at the bank. And ultimately what happens then is we get complacent and we aren't as vigilant. And so we get caught a little bit by surprise as investors and start feeling feelings of anxiety and then denial as our investments begin losing value. And ultimately that leads to other feelings like fear, panic, anger, and even depression. And what so often happens is we see individuals allowing their emotions to dictate their decisions. A recent study has found that over the last 20 years, the S&P 500 has returned somewhere right around 9.5% a year on average, whereas the average investor has earned somewhere around 4.5% a year on average. Now, depending on what time period you look at, that number might change, but what typically holds true is that the average investor earns about 50% less than the market as a whole. Now, there are a number of factors, but the largest factor to why that is emotions and people making emotional decisions. And it's okay to feel emotions, and it's important that you recognize your emotions, but you don't want to be making emotional decisions as an investor. And so what it's our job to do is to learn from the past and make sure that we have a process in place to help us in the future. I think this past year is a great illustration of this. We came into the end of February, the market was chugging along pretty well, and then we had the COVID-19 virus come up and the COVID-related shutdowns began, which led to a very sharp decrease in value in the S&P 500. At the bottom of the market, which occurred on March 23rd, the S&P was down just over 30%. Obviously, if you've been able to ride it out and just held pat, and if you were investing in the S&P 500 today, you'd be up somewhere around 22%. Now, obviously, what happens a lot of time is people sell somewhere around here. They sell halfway or almost all the way at the bottom because the pain becomes too great and the fear of loss begins affecting people's decision-making process. And then as the market begins to recover, investors scramble and start getting in somewhere around here. So rather than selling high and buying low, people end up selling low or lower and buying high or higher. As investors, that is where that 50% less return really creeps in to your portfolio. And I think it's important to recognize what happens when you have a process. Now, this isn't to say that we're always going to do this and we're going to nail it every single time, but last year is very illustrative of how our process worked. This is our moderate aggressive model, the orange line. And what you'll see here is we stuck to our process. We managed the models and our investments for our clients using the strategy that we developed over the last 20 years. And the results speak for themselves. At the bottom of the market on March 23rd, the S&P was down just north of 30%, whereas our model was down just north of 19%. And then obviously today, had you stayed invested with us that whole time, you'd be up north of 57%, whereas the S&P is up 22%. Now, a lot has to go right to make that happen. But what is most important to recognize is having a process, trusting the process, and executing on that process leads to long-term results as an investor. And ultimately, the reason we want to maximize our return for the amount of risk that we're taking in our investments as investors is so that we can achieve the financial goals that we have in the shortest period of time possible. And at the end of the day, that's what my team does for all of our clients. We're here to help you avoid making those emotional decisions and rather using logic and reason and trusting the process to help you develop the returns that you need. So what I would encourage you to do is take some time and think through how you've reacted emotionally in the past whenever markets start going crazy. And if you recognize that you oftentimes give into emotions, that might be a sign that you are too aggressively invested in your investment accounts. Or if you're someone who you are good emotionally, you hold pat, you don't look at your investment statements, you don't really get concerned, but you held pat and now you have some massive gains, it might be time for you to consider reducing some risk as we now are approaching a new period in our economy where the market is near all-time highs and our economy is beginning to reopen. It might be time to take some of those gains where you've done the right thing and put them in the bank, take them off the table. And so what I would encourage you to do, think through where you stand today, think through how you've reacted emotionally in the past, and let's talk about it. Give us a call or talk to a trusted advisor who can help you walk through what your options look like with where we stand today. Once again, guys, thank you so much for your time. We appreciate each and every one of you, and we'll talk with you soon.